Today I want to talk about something that doesn't get enough attention in real estate, especially in creative finance circles. A lot of people ask, does the structure work? Can the deal close? And can I get paid at closing? These are valid questions, but they're not the most important ones because sometimes, this happens more often than people want to admit, the structure's right, the asset is wrong. And if you don't know how to tell the difference, you'll end up owning a deal that slowly bleeds you instead of paying you. Most investors are trained to think in binaries. Deal works, deal doesn't. Math works, math doesn't. Or creative, not creative. But deals live in a gray area. I've seen deals where the capital stack's clean, the lender path is clear, seller is flexible, and the mechanics are sound, and we still passed, not because we couldn't close, but we shouldn't. This is where most people get confused, and this is where experience matters. Let me say this clearly, a valid structure does not mean a good deal. A Morby method can be executed perfectly and still be a bad investment. A DSCR and seller carry can pencil and still be fragile, and a zero money in deal can still be overpriced risk. Why? Because the structure only magnifies the underlying asset. A good asset and leverage equals acceleration. A weak asset plus leverage, amplification of risk. Creative finance doesn't fix demand, it doesn't fix bad rent comps, and it doesn't fix market mismatch. It just turns the volume up. Let me give you a real example. We reviewed a Morby-style double close in California. On paper, the structure worked, and this is a deal I talked about in my last videos. The math worked. The buyer could get paid at closing, and the lender execution was possible. This was not a fake deal, and it wasn't sloppy math. If you saw it, was a $950,000 purchase price. And this wasn't a misunderstanding of the method because we clearly explained that in the last video. It was real. Then the pivot. Here's why we passed, or my partner who brought it to me, John. Walking through the asset realities. Primarily, this home was in a family community, but it had a poor school district, which means weaker long-term demand. It's not a strong job hub, long commute patterns, plenty of affordable apartments nearby. Could it rent? Yeah. Would it cash flow? Barely. And even with co-living, it was basically break even. And break even is not a strategy, especially when you're stacking leverage and balloons. This is another mistake people make. They say it doesn't cash flow, just co-live it. That only works in the right markets. Co-living thrives where jobs are dense, rents are compressed, young professionals cluster, and room rents beat studio rents by a wide margin. This market didn't have that. For a few $100s more, tenants could get their own apartment, privacy, and no roommates. So the co-living upside wasn't real, it was theoretical. And I don't invest on theory. Here's the part people really miss. When you combine high leverage, thin cash flow, a balloon note, and market-specific demand, you've built a deal that has no margin for error. No vacancy cushion, no rate shock cushion, and no refinance cushion. That's not investing, that is hoping. A deal that only works if everything goes right isn't a deal. This is how I evaluate deals now. Number one, does the structure work? Number two, does the lender path exist? And number three, does the asset want that structure? That third question is the one most people never ask because sometimes the right answer is this structure belongs on a better asset. If you're bringing a deal to me, not just to tell you if you can close it, I'm going to tell you where it breaks, what assumption is fragile, and whether the asset can actually support the structure. Because passing on a bad deal is just as valuable as closing on a good one. If you want help reviewing or restructuring a deal the right way, drop it below or reach out. I'll tell you the truth, even when it's not the answer you want.